The next session. I hope everyone's still with us and taking notes, because up next we have a session on decoding recent regulatory changes, compliances, and due diligence frameworks. This is a crucial area for any of y'all in the industry. So please welcome Mr. Shikhar Kacker, Counsel at Khaitan, and Rahul Jain, Partner Tax at Khaitan & Co. A big round of applause, ladies and gentlemen.
Hi, good afternoon, everyone. So we'll try to be as brief as possible, because this is something that, more like a knowledge catch-up, and we just wanted to walk you through the recent changes that have come about, both at the domestic AIF level as well as the GIFT City level. And then Rahul can come in and we can talk about the tax aspects, and maybe then you can engage in a Q&A session if required on all the regulatory changes and how industry is looking at those industry changes. I think a brief snapshot would be, this is a big one, because an industry issue, most of the AIFs, or rather it started with the VCF industry, because right now the VCFs are facing a very critical situation where the tenure has come to an end. And due to both business challenges as well as regulatory challenges, they've not been able to liquidate the scheme. Ideal situation would be that you reach out to the investors, and if the investors are on board with the extension of the tenure, then you naturally extend the tenure, because the law does not say specifically what will be the tenure of a scheme. But the way SEBI looks at it is something at a divergent view with the industry. And SEBI, in the series of orders that it has passed in the recent times, has very categorically said that regulatory challenges that you're facing or any commercial challenge that you're facing cannot be a good enough reason to not wind up the fund. So you are supposed to be a limited life entity, and please wind up the fund. But at the same time, SEBI somehow at a later point in time acknowledged that we need to come up with a solution to the problem. So they first proposed a concept of a liquidation scheme only for AIFs. Now, AIFs is still at a nascent stage right now. Not all AIFs are facing this problem, but definitely most VCFs are facing this problem. So there was no leeway given for VCFs that what are the existing VCFs going to do whose tenures have come to an end. So in the framework which SEBI has proposed last year, it said that you float another scheme under the same trust and call it a liquidation scheme, transfer the assets in that scheme, and give the dissenting investors an exit. Now, this regime never took off for various regulatory and tax reasons, because no one knew that what happens if you transfer the asset from one scheme to the other scheme, the tax implication, and from where will you get the bids for giving an exit. And the point is that the target audience was VCF, and target audience was not the AIF industry. So at that point in time, SEBI has now floated another consultation paper and has now come up with certain amendments to the regulation. So all three aspects being addressed. You don't need to suffer any adverse tax or regulatory consequence, because you don't need to float a new scheme. All you need to do is you need to reclassify yourself as a liquidation scheme after the expiry of your tenure. And SEBI has given you an additional 1-year window within which you can liquidate. Thereafter, you can opt to be a liquidation scheme. Existing VCFs have also been given this option now, though the notification is yet to come out, but at least in principle, the board has approved of this proposal. VCFs which are facing a liquidation problem can now opt to be classified as a dissolution scheme and will be allowed to opt for this method. The key processes are going to be that everything in the AIF industry works on supermajority consent. So you need to have supermajority investors on board before you can think of distributing, moving to a liquidation scheme. Otherwise, you either make an in-specie distribution or you sell the assets. I mean, SEBI has come out with, while there is no guidance, legal guidance on this, but based on various SEBI orders, SEBI says that you get an independent valuer or it come up with the bidding process so that the best price discovery is possible. So over here also, you need to take 75% investor consent. Dissenting investors have to be given an exit from the bid that you're procuring for the remaining 25% of the assets. And the term of the liquidation scheme cannot be beyond what the original intended scheme of the term of the scheme was. So that's what the new set of regulations are, and hoping that at least VCFs once it is notified, and existing AIFs are actually able to not get into any regulatory loophole now. The only caveat that SEBI has added is that once you are in a resolution period, you can't be charging any additional management fee. So managers will have to be mindful how they manage how they manage their fees component when they're in the liquidation period. We can move to the next one. This is again more of a administrative reprieve that SEBI has given to most of the funds now, because somewhere in 2020 SEBI came out with the requirement that you need to be filing all the PPMs through an intermediary, and the intermediary has to certify the genuineness and the veracity of the contents of the PPM. Now this became problematic because SEBI required AIFs to update their PPM on an annual basis. Now this annual basis, most of the PPMs do not necessarily have any material changes to the document. There are going to be routine investor updates which are anyways being communicated by way of investor communication, or due to change in law, you are going to be updating the regulatory and tax sections of the PPM. So various representations were made to the industry, and then SEBI has finally decided that you continue with making those annual updates, but you don't need to come through the merchant banker in case there are non-material changes. So I've tried to keep a brief list of non-material changes over here, which are going to be change in contact details, change of lawyers and tax advisors, change in the corpus of the fund, change in the commitment period, because now commitment period now the term of the fund is not linked to the commitment period. Now the term of the fund is linked to the date when you declare the first close. So pursuant to that, SEBI does not deal as change of the commitment period as a material change. Change in KMP until unless it is not triggering a sponsor change in control, which is anyways a SEBI approval event. Anything beyond this is considered to be a material change, and then you need to go back and make the filing through a merchant banker. This is again a big one, or rather we thought this is going to resolve the industry issues, but rather it has created more problem for the fund managers, because SEBI had a criteria that the key personnel of the fund, one person needs to have at least 5 years of work experience, the other person needs to have a professional qualification in the area of finance and accountancy and commerce. So new age fund managers found it very difficult to comply with the five-year experience criteria. So SEBI said, okay, we'll introduce an objective criteria. And they have introduced, last year they notified that we'll come up with a certification requirement. Now, very suddenly, they have now come out with a certification requirement. This certification requirement is going to be an SIM course. But unfortunately, the course that has been designed, it does not make a distinction between a Cat 1 manager, Cat 2 manager, or a Cat 3 manager. All three managers have different investment strategies and different outlook how they are going to be managing, and the skill set required is very different. But right now, there's a common single exam. Existing applications, existing AIFs and those applications which are already filed with SEBI, their managers have a 1-year window to clear the exam. But those who are in the process of filing the fresh application have to give an undertaking that they will clear the examination and they will share the scorecard, basis which only SEBI is going to be giving the registration certificate. So this is becoming very challenging. The examination slots are not available in most of the big city centers where the fund managers are available. Secondly, a Cat 1 fund manager need not know how to do hedge fund accounting, but still he has to learn that course and has to make sure that he is securing at least 90 marks to be able to clear the examination. So this is something maybe industry SEBI should take a look at, and they should come up with very specific courses for the category in which I'm going to be managing my fund. So, now this is where we enter the gray area. So tools, if you see, SEBI has always had a problem with evergreening and senior-junior structures. And SEBI somehow feels that some of the AIF structures are being misused to circumvent the foreign investment regulations. So under the FEMA guidelines, FDI into an AIF is permitted up to 100% under the automatic route without any prior approval requirement. And the money which is being deployed by the AIF into portfolio companies is also treated as domestic investment if the manager or the sponsor are, both manager and sponsor person resident in India. So the color of LP money does not decide whether the portfolio investment will be treated as FDI or not. Now, as per SEBI, this structure is, as per both RBI and SEBI actually, if you see the board minute meetings and the discussions which they've had in the board minutes, as per them, this appears to be a very convenient conduit to circumvent the FDI regime. And most of the fund managers are setting up structures which have domestic managers, 100% foreign money, for being investing into sectors in which otherwise FDI beyond a certain sectoral cap is not permitted, or using this as a very convenient vehicle to make pure debt investments which otherwise are subject to stringent ECB guidelines, or you need to be a regulated NCD where the investment limits are capped and part of the overall limits provided by RBI from time to time. So, given that it's a government, it's an FDI issue and it's a RBI issue, and SEBI can't be doing anything about it, so they've put in an innocuous amendment to the regulations, casting an obligation on the investment manager to carry out due diligence when making a portfolio investment, and to ensure that the investment does not circumvent the FDI and financial sector norms. Now, what that means is something we are still at a very nascent stage, but hopefully the standard setting forum which has been constituted is likely to come up with more solutions, because on the face of it, this is subject to a very strict interpretation, and the first target are going to be banks which are foreign owned, because those banks have substantial debt exposure to the Indian markets. There's also going to be strategic people who have made very specific strategic investments in sectors in which FDI beyond a certain limit is not permitted. So I think while this may appear to be a little harsh on the first read, or it can potentially be interpreted very strictly, but there's a lot of hope from the standard setting forum that they are going to come back and go to SEBI with a more objective criteria, so that both there is a bit of clarity how the foreign investments have to be made and what is the level of diligence which the manager has to exercise. And lastly, what happens to the existing investments, because those existing investments cannot be unwound, so there has to be a solution to those problems. So hopefully those are going to be the expectation that, and we hope that it's going to be in favor of the managers. And this is, I think, the last SEBI-specific amendment that I wanted to touch upon before we move to GIFT City. This is again, last year, SEBI thought, SEBI had been contemplating that whether senior-junior structures are good for the industry or not, because a typical senior-junior structure would be that an investor who has a larger risk appetite will invest into an AIF, and he will say that my returns will be higher than what other investors are getting, but the returns will start kicking in once the investors who are coming at a lower investor return are being paid off. That's the typical senior-junior structure, an accepted industry norm. But as per SEBI, there were concerns around a senior-junior structure, and SEBI thought that in these structures have been misused by NBFCs and banks by dumping their bad loans into our books and taking a junior position in the fund. So SEBI came out with the circular that going forward, don't make any further drawdowns for senior-junior structures, but existing investments can continue. So far, so good. But one fine day, RBI comes out with a circular and says that if a bank has invested in a fund which has exposure in the same portfolio company in which bank or an NBFC has given a loan exposure, such investments have to be unwound within a period of 30 days. Going forward, you can't make these investments, and if you can't unwind these investments, then you make a 1:1 provisioning in your books of accounts. Now, this caused a lot of, I would say, loss of business to the industry, both to AIF portfolio companies as well as fund managers. And the challenge was most of the AIFs have exposure from banks and NBFCs, and as part of their treasury exposure, these exposures are treasury exposures, and banks are invariably going to have a common portfolio company in which a fund would have invested. So after a series of consultation with DEA, RBI has finally given some relaxation, which obviously is not up to what industry expectation has been, but these relaxation essentially mean that in case the AIF is making equity investments, then this restriction on regulated entities do not apply. The regulated entity can continue to be an LP into a fund. The second bigger clarification is that in case, or rather this circular itself became a problem for Government of India because there are several fund of funds set up and sponsored by government, which are NBFCs. And these funds have exposure in, with a corpus of say 10,000 crore, have exposure in various daughter funds. So this circular became a problem for the government itself, that they could not go and invest in a daughter fund because on one hand they are an NBFC, on the other hand they have a government mandate to disburse money for portfolio companies. So they came out with an exemption that in case the money is coming through a fund of fund model or through a mutual fund, the downstream investment restriction will not apply. Now, while this has been a reprieve, a part reprieve, the larger question is that the idea was to stop misuse of senior-junior structures and evergreening of loans. Now, evergreening of loans is only possible if the portfolio company has accepted debt from a fund and the LP whose portfolio is being transferred to that AIF is able to influence the decision-making process of the AIF. Now, in absence of these two tests, any other restriction which is placed on a bank or a financial institution when taking an exposure in an AIF is fairly regressive, is counterproductive, and it creates a lot of problem in fundraising for AIFs because banks are the first port of call for most of the AIFs who are looking to reach out to funds for the first round capital raise. And banks have a fairly large size, 10% of their overall corpus of the AIF, they can invest into a AIF. So this is one area where perhaps we are likely to see some more relaxation, but so far the only relaxation is that if the fund is making an equity investment, then you can take money from a bank or an NBFC. Then we move on to the next set. This is going to be very minor amendments have come out. I think I'll first take the ease of doing business part. So, unlike SEBI, IFCA does not regulate the fund, but it regulates the manager. And manager has the flexibility to launch schemes after it is registered. Now, so far, and also it also talks about a green channel, which you launch a scheme document, you file a scheme document, and after 21 days thereafter, you can start accepting commitments. Whereas there's something called as the green channel also, where you don't need to wait for the 21-day period. If you are a fund, if you're a non-retail fund and have accepted money only from accredited investors, or you're a venture capital fund. But IFCA has made certain more relaxation and has now included all categories of non-retail products under the green channel without any accredited investor acceptance requirement. The only conditionality they've attached is that going forward, certain minimum provisions which are standards and specific terms which IFCA is now prescribing have to be included in the PPM, and you have to give an undertaking that our PPM is in compliant with these minimum disclosure standards which are supposed to be there, so that you don't need to wait for the 21-day period and you can keep launching the scheme the moment you file the document with IFCA. These are effectively on similar lines at what SEBI has prescribed. While SEBI has prescribed a template itself, IFCA has not prescribed any template, but it has given certain specific provisions which are already there in the SEBI template have to be included over here. What's not specifically required is excuse period, default period, because these are very specific terms which SEBI insists that you should be having in your fund document. And so IFCA is acknowledging that these are something which clauses which should be a subject matter of negotiation and discussion between the fund and the LPs. So excuse, default provisions, the track record of the manager, these are specific provisions which have not been provided, and we are now entering into a more of a fast-track green channel zone. The only hope would be that even SEBI has prescribed a template, but SEBI officers end up scrutinizing the commercial terms of the PPM as well. And it goes into a loop where you have to keep on explaining why your fund commercials are different from other fund documents in the market. So one can hope that while IFCA is now prescribing these minimum disclosure standards, but it should not happen that they also start taking the SEBI path of coming back and started commenting on, say for example, the most common being side letters, that why your side letters being giving these XYZ rights. So one can hope that this is not the IFCA intent. Then we'll come back to, this is a very specific amendment. It's actually both the SEBI and IFC amendment. This is a big one for the hedge fund industry for public market investments, because while NRIs and OCIs have a separate investment route available to them, but the limit is available to them at a 5% portfolio level, and that too if they're investing directly. Whereas in today's day and age, most of the NRIs would want, they are the largest source of foreign investment into India, and they would want their money to be going into the Indian capital market. But as such, because of the existing route which is available to them, they were not able to fully participate in the FPI route. And FPI route has made certain relaxation, wherein an individual participation by an NRI into an FPI vehicle cannot exceed 25% of the corpus, and in aggregate cannot exceed more than 50% of the corpus. And this became a cause of concern for all the NRIs because they could not increase their exposure. There was no legitimate route for them to increase their exposure to the India capital market. So there were a lot of representations being made to both SEBI and Government of India to enhance these limits. But government was not very keen to enhance these limits for certain specific reasons. Prior to 2002, there used to be a special regime type of entity called overseas body corporates. Overseas body corporates were those entities which were held by NRIs. Now, after the stock market scam, there was a joint parliamentary committee that was set up, and that committee was of the opinion that most of these overseas corporate bodies are essentially conduit for round tripping and for laundering the money. So they stopped this regime, and NRIs were only given a very limited window to participate. Now this problem came into sight once again when the Hindenburg report came out, and there's something on similar lines, these allegations of round tripping and promoter money was being made in certain specific entities. But at that point in time, SEBI came out with a circular asking FPIs that in case your disclosure they prescribed a size and concentration threshold, that in case your exposure to a particular entity or in case your overall exposure to Indian market is above certain thresholds, which is 3 billion USD and 50% of the total AUM, then you need to go out and give granular disclosure of all your UBOs. Now, it was a blessing in disguise that SEBI has come out with a circular. Government and everyone got an opportunity to cite that circular and tell SEBI that use this circular to give dispensation for IFSC-based funds, because while you may have had problem in tracing who the UBOs are from other jurisdictions, but in case you have a regulator under the supervision of the same ministry, it's much easier to go and take the investor granular details. So now they have amended the IFSCA regime. They've given a relaxation to IFSCA-based funds, and effectively you can have 100% NRI participation in a fund, subject to their PAN being available. In fact, a further relaxation has been given to bank-sponsored mutual funds. If there's a bank-sponsored fund which is operating under the IFSC regime as an FPI, that fund need not provide even the PAN, it just need to make a disclosure. There are certain different thresholds of when a granular disclosure gets triggered. But this is going to be a big opportunity for wealth managers, stockbrokers who wish to manage, who have been managing NRI money in a very piecemeal manner. This is going to be a great opportunity to pull in and bring in all the NRI and OCI wealth back into India. I think these were my slides in a quick run through of the updates. Now I'll request Rahul to please discuss some of the tax specific nuances.
Hello everyone. This is a topic which could take more than hours, I think, but let me try and give you a broad overview. Gift City, we've been reading every day what's happening, why Gift City, what are the benefits, why do I move my offshore pooling fund to Gift City, and given the sheer number of questions that we come across, we thought maybe a good idea to give you an overview. Uh, So I'll skip the introduction part. I think Shikhar has covered the base. Let me just show you this is how a typical gift city structure looks like. And there could be multiple variants to it. You'll generally see two variants. One is wealth managers setting up gift city fund for pooling in the retail money and investment overseas, and the offshore pooling funds being relocated to gift city. Now, and that's the biggest advantage. That's the biggest number of schemes that we've seen being launched in gift city, which are closer to that variant. So this is how a typical structure would look like. You'll set up a fund management entity in the gift city, which could be in the form of a company or a partnership firm or a branch of your existing entity. The fund management entity launches a scheme which could be a category 1 AIF, category 2 AIF, or category 3 AIF, like we know, and the considerations are similar like you have for a SEBI AIF. You'll pool in the money from offshore investors or from Indian investors and move ahead with your investments. Let's talk about ourselves first. What are the key benefits for the manager entity? One is there is a corporate tax holiday for the management entity for a period of 10 years, and that's within a block of 15 years, which starts from the date you have set up your fund management entity. If you, again, like we discussed, the fund management entity could be in either of these three forms, either a company or an LLP or a branch. While you don't have corporate tax being paid, if you are set up as a partnership or a LLP, you may be liable to pay an alternate minimum tax, which is around about 10%, right? So that's your net cost of setting up the gift city manager entity, right? Let's talk about AIF, right? And AIF, again, gift city has two regimes in place, I would say. One is your category 1 and category 2 AIF, which the current pass-through regime has been extended to gift city AIFs also, which means what? Which means the AIF is not liable to pay any tax, but your investors pay the tax. And if there is any business income, which is of course unlikely, you can always look at claiming the tax holiday also. So you generally had always this nuance that if I'm setting up a category 2 SEBI AIF, and if I have business income, what happens? You could be liable to full taxes. In a gift city AIF, that is something which you could structure it very well, that even if some element is, let's say, a business income, you may consider claiming a tax holiday. So that's one of the biggest advantage of a gift city category to AIF. What happens to the investors? I think investors, as we all know, what is happening today with the SEBI AIF, the tax treatment remains the same. The income is flow through to the investors. If the AIF wants dividend income, it's taxable as a dividend income for your in your own hands. As an AIF, I have an obligation to withhold tax, which is 10% for Indian resident investors and full taxes for non-resident investors. Why I think the gift city AIF makes much more sense based on our discussions with number of clients. One is of course where you had India managers having offshore pooling funds, and you had a Mauritius manager, let's say a Mauritius fund, Mauritius manager, and you had a sub-advisory arrangement with an Indian entity. You always at the risk of whether someone can allege the Mauritius manager of the fund is being controlled from India and therefore has those permanent establishment risk, place of effective management risk. I think that gets completely mitigated in this structure because you are no longer required to have an offshore structure. Second is the whole tax treaty bit, whether a Mauritius fund will be eligible to claim tax treaty benefit. Now here, because you are not required to have an offshore fund, you are moving your offshore fund or a pooling vehicle to gift city, that goes away, right? And the investors are liable to pay tax directly in their own hands. Investors would have anyway be paying taxes in their home jurisdictions. They can claim credit of those taxes. So investors are also not worse off, right? So it's a win-win for all of us. Category 3 AIF, and this is one of the very interesting tax regime which has been brought in. Now, if you look at a category 3 AIF, a normal category 3 AIF with Indian resident, non-resident investors, you can set it as a trust, and that's a general trust taxation treatment which we have even today for SEBI category 3 AIF, so nothing changes. But for a category 3 AIF which has only non-resident investors, there is a special tax regime which says the investors are tax exempt. on the distributions they receive from the fund as well as on the transfer of the units if there is any. So investors are exempt from tax, not required to obtain permanent account number, not required to file tax returns. So investors are completely benefited out of it. If you look at the AIF, what is happening to AIF? AIF has also a host of benefits, which means AIF pays tax only on interest income and dividend income, which is a flat rate of 10%. There is no surcharge in cess. This 10% rate has been brought in to make it competitive with most of the tax treaties. So I would say, apart from Mauritius, which gives a 7.5 tax rate on interest income, there is no other treaty which gives tax rate lower than 10%. And similarly for the dividend income. Another income which is taxable is your capital gain on sale of equity shares in an Indian company, which is taxable at 10% long term or 30% short term. If you're doing debt instrument, if you're doing securitization, if you're into derivative trading on the IFSC exchange, that is completely tax exempt. So again, that's something, you know, which is a clear benefit out of there. Relocation of the offshore funds to GIFT City Fund has been made tax neutral, of course, to get you all the benefits and to ensure seamless transition. There are, of course, certain conditions which are there, which are, of course, not onerous and easy to comply with. And this is probably the last slide where you see a comparison of what do you do when you have an offshore fund vis-a-vis your GIFT City Fund. And what are the tax benefits. As you can clearly see over here, an offshore fund vis-a-vis a category 3 AIF, and category 3 AIF always stands out. Category 2 AIF, of course, I would say not benefit in terms of tax cost, but in terms of the whole structural aspect of having a manager with an Indian advisor, you are able to, you know, just get over it. Okay, I think that was it. Any questions? Happy to take them. All right, thank you so much.
Thank you so much, Rahul and Shikhar, for that comprehensive overview. This definitely helps us understand the increased regulation and providing additional services to help managers comply with the ever-evolving regulatory reporting requirements in the AIF sector. So thank you for that. As a token of gratitude, we would like to present you with a gift. And for that, we would like to call Mr. Senthil on stage, please. Huge round of applause, ladies and gentlemen. Thank you so much, Rahul and Shikhar. Thank you, Senthil. So before we move on, it's time for our second round of quiz questions, and I would like to call Ms. Rakhi Batija back on stage, please. Round of applause, ladies and gentlemen.
Hi, everyone. Time to put on your thinking caps. Just a quick few fun questions rather. Let's see who gets it this time. But a small request, 2 people have already won the prize, so let's give others a chance, please. We'll find all the power pack gifts going to only one person. Okay, I think this is going to be an easy one. What kind of a tree can you carry in your hand? Superb. Ankit has won the prize. Please, can you give it to him?
Congratulations, Ankit. Keep clapping, everyone. Come on.
Thank you. Thank you. The next one. My rate may vary with term applied. In real estate, I often abide. You were close. Somebody said interest rate. No, you can get better. You're an earring. Can you hear some murmurs? I'll repeat it. My rate may vary with term applied. In real estate, that's the key word. I often abide. Rate and real estate. Guys, that's the hint. Sorry? No, real estate. Real estate rate, no. There you go. Mortgage, that's the answer. So I get the opportunity to click a picture with everyone. Can I get your name? Can I announce your name, please? Oh, sorry, yes. Anand Kailash has got it. Okay, listen to this very carefully, every single word. You see a boat filled with people, it has not sunk. But when you look again, you don't see a single person on the boat. Why? I can see smiling faces. I think I'm going to get the answer. I'll repeat. No, I'm going to repeat it. I want the answer quick before you guys can Google it. You see a boat filled with people, it has not sunk. But when you look again, you don't see a single person on the boat. Sorry? Sail away. No, it's still in the middle of the water. And it has not sunk. But good try. But you don't see a single person on the board. Find the answer there. What's that? Escalation. You're getting close, lady. Perfecto. You get that. Please give him a big hand. You're married, huh? You're married, right? कुछ चल रहा है लगता है. Thank you. The answer was that married people, because you can't see a single person on the board because they were all married. Thank you, everyone.
Thank you, Rakhi, and congratulations to the winner.